In the autumn of 2025, the relationship between the United States and China reached a perilous crossroads. Tensions, which had been simmering for months, suddenly escalated, pushing both nations to the brink of a diplomatic crisis. The world watched anxiously as the two superpowers exchanged sharp words and issued stern warnings, their actions reverberating across the globe. Aggressive rhetoric replaced the last remnants of fragile diplomacy. New trade restrictions were imposed almost overnight, sending shock waves through international markets and alarming governments worldwide. The global community grew increasingly concerned as the prospect of a prolonged standoff threatened economic stability and peace. In the midst of this turmoil, a pivotal phone call between President Trump and President Xi offered a fleeting glimmer of hope. The two leaders, under immense pressure from their advisors and the international community, agreed to open a direct line of communication. Their announcement of plans for a face-to-face meeting was met with cautious optimism. Financial markets responded almost instantly, surging on the news. Investors and analysts alike hoped that this diplomatic breakthrough might ease tensions and restore some measure of stability to the global economy. However, the optimism was short-lived. Within days, the United States unveiled a new set of provocative measures, reigniting hostilities and dashing hopes for a quick resolution. Protests erupted, and trade ground to a halt as both sides dug in their heels. The cycle of pressure, suspicion, and mistrust proved too powerful for any diplomatic gesture to overcome. Negotiations stalled, and the atmosphere in diplomatic circles grew even more tense. Instead of progress, the aftermath of the call only deepened the divide. Military posturing increased, and the world's media reported on the growing risk of open conflict. The fundamental disagreements and lack of trust between the two nations only intensified, making compromise seem more distant than ever. What began as a rare chance for dialogue quickly unraveled, becoming a prelude to a new and more dangerous phase of confrontation. As both sides prepared for further escalation, the world braced itself for the economic and political fallout, uncertain of what the future would hold. Hopes for de-escalation between the world's two largest economies quickly vanished when the United States imposed a sweeping set of export controls on China, sending shockwaves through global markets and diplomatic circles alike. These new restrictions specifically targeted critical technologies such as advanced semiconductors, artificial intelligence hardware, and other high-tech components that are essential for next-generation innovation. While U.S. officials justified the move as necessary for national security, Beijing saw it as a direct attempt to stifle China's technological rise and undermine its ambitions to become a global tech leader. In addition to export controls, the U.S. government expanded its blacklist, effectively cutting off major Chinese firms from vital American suppliers, software, and intellectual property. For these blacklisted companies, the consequences were immediate and severe. Production lines stalled, partnerships dissolved, and their very survival in the fiercely competitive global market was thrown into doubt. China's response was swift and uncompromising. Officials condemned the measures as blatant protectionism and accused Washington of hypocrisy, arguing that the U.S. was using security concerns as a cover for economic self-interest. Beijing's leaders publicly accused the United States of weaponizing trade policy to suppress fair competition and maintain its own technological dominance. What began as a trade dispute had now escalated into a full-blown technology war, with both sides digging in and preparing for a prolonged standoff that would reshape the global tech landscape. The new restrictions marked a decisive turning point, signaling a shift from traditional trade disagreements to a deeper, more strategic rivalry that would impact industries worldwide. Global technology companies, from chipmakers to software giants, suddenly found themselves caught in the crossfire, forced to navigate a landscape filled with uncertainty, shifting regulations, and the constant threat of further escalation. The escalation made it clear that neither Washington nor Beijing was willing to back down easily, and that the standoff could last for years, if not decades. As a result, the world's intricate technology supply chains, once symbols of global cooperation, were now effectively held hostage by geopolitics, with ripple effects reaching every corner of the planet. The stakes for the global economy had never been higher, as investors, businesses, and governments alike braced for an uncertain future shaped by this new era of technological rivalry. The trade war soon hit American agriculture, with soybeans at the center. China, once the largest buyer of U.S. soybeans, slashed its purchases in retaliation, devastating American farmers. This targeted move aimed to inflict maximum economic and political pain. Simultaneously, Disputes erupted over port fees, with the U.S. accusing China of unfair charges on American ships. Washington claimed these fees were discriminatory, further straining trade relations. China rejected the accusations, insisting its practices were fair and in line with international norms. The standoff over soybeans and port fees exposed the depth of economic distrust. These weren't abstract policy battles. They had real consequences for farmers and shipping companies. The conflict was now felt in rural America and at global shipping hubs. Everyday commerce had become a weapon in the escalating trade war. The global economy's interconnectedness was on full display. In a dramatic escalation, China raised the stakes in the ongoing trade conflict by threatening to restrict exports of rare earth minerals, an essential group of elements that power the modern world. These minerals are absolutely vital for manufacturing everything from smartphones and electric vehicles to advanced defense systems and renewable energy technologies. With over 80% of the global supply of rare earths under its control, China holds a near monopoly on these critical resources, giving it enormous leverage over international supply chains. News of China's potential export restrictions sent shockwaves through Western industries, sparking immediate concern among manufacturers and policymakers alike. The United States, which has long depended on Chinese rare earths for its high-tech and defense sectors, suddenly faced a glaring and critical vulnerability in its supply chain. Beijing's threat was more than just rhetoric. It was a clear warning to Washington that China could disrupt the flow of materials essential to America's most strategic industries. If China followed through, it could bring production in America's most advanced sectors, technology, defense, and aerospace, to a grinding halt. In response, President Trump dramatically escalated the situation by threatening to impose a 100% tariff on all Chinese imports, a move designed to pressure Beijing but fraught with risk. The announcement stunned global markets, triggering panic on trading floors and sending shockwaves through financial centers around the world. Such a sweeping tariff would instantly double prices on countless everyday goods, from electronics to clothing, hitting consumers and businesses hard. Economists warned that this tit-for-tat escalation risked plunging the world into a deep global recession, with millions of jobs at stake. The standoff pushed both nations to the brink, as negotiators struggled to find common ground and avoid a full-blown economic war. Each side now wielded powerful economic weapons, threatening to inflict maximum pain on the other in a high-stakes game of brinkmanship. Around the world, businesses scrambled to assess the fallout, racing to secure alternative suppliers and brace for further shocks. The threat of mutual economic destruction loomed large, casting a shadow over global growth and stability. Both President Trump and President Xi Jinping now faced immense pressure from their own governments and citizens to avoid catastrophe and find a way out. The world watched anxiously, uncertain if either side would back down or if the conflict would spiral out of control. In this tense moment, the fate of the global economy truly hung in the balance, with every decision carrying enormous consequences for the future. Despite public threats, diplomatic channels between the US and China stayed open. Behind the scenes, officials recognized the dangers of a total breakdown. Video conferences between top economic officials became vital for clarifying positions and preventing miscalculation. While no breakthroughs emerged, these talks kept the door open for negotiation. Both sides balanced public confrontation with private dialogue. The willingness to keep talking showed a shared understanding. Negotiation was the only way out. This period highlighted the complex dance of pressure and diplomacy. What happened behind closed doors was as crucial as the public posturing. After weeks of threats, President Trump's tone shifted from confrontation to cautious optimism. He predicted a fantastic deal with President Xi, calming anxious markets. China welcomed the change, emphasizing the importance of direct leader-to-leader talks. Both sides signaled a desire to elevate negotiations above technical disputes. Economic leverage and national security concerns remained bargaining chips. The environment was fluid. Prospects for a deal changed daily. Public optimism, even if tactical, offered hope for a breakthrough. The US and China were searching for an off-ramp from the trade war. The tension between confrontation and cooperation defined their relationship. The US-China conflict wasn't the only trade fight. Tensions with Canada also flared. This showed America's confrontational trade stance was global, affecting allies too. Media coverage of the US-Canada dispute doubled as a pitch for paid journalism, highlighting the value of trusted reporting. The Financial Times used the story to promote its subscriptions, blending news with marketing. The article underscored the importance of reliable information in a turbulent world. Media outlets were adapting, using coverage of global events to sustain their business. The events of fall 2025 revealed the perilous complexity of modern global trade. Economic policy, national security, and politics were now deeply intertwined. Tariffs and export controls became tools of statecraft, not just economics. The US-China standoff showed the delicate balance between confrontation and cooperation. Both sides used hardball tactics but never abandoned diplomacy. The search for a breakthrough was a high-stakes, unpredictable process. Leaders' statements swung from threats to hope, reflecting the volatility. Navigating these disputes required leverage, patience, and a willingness to talk. Smart diplomacy proved essential in preventing disaster. In an interconnected world, negotiation remains the key to stability.